For more on these new regulations and the impacts they will have, William Black joins us live from Kansas City. He's a former federal regulator and also professor of economics and law at the University of Missouri. Professor, welcome to the show. We need your help. Let's start with too big to fail and systematically important. What does that mean?
Well, that's a euphemism for what is actually systemically dangerous institutions. So the conceptual definition is, if this bank fails, will it cause a potential global crisis? It's not because they're important. In other words, these banks are inefficient, not efficient, and the world would be much better off without them. But they're hanging like about 40 swords of Damocles over the world economy.
So the headline today was that GE and AIG may possibly face more regulation. Are they too big to fail?
Yeah, and they were bailed out already in the last go-around, and there's nothing, played the language from President Obama saying never again, but there is absolutely nothing in the law or the rules adopted since or on foreseeable that is going to get rid of the systemically dangerous institutions. They've decided that they can create a tame tiger, and it ain't going to happen. It's not a question of if we're going to have a next global crisis because of these institutions. It's only a question of when. All right.
We'd like to, by the way, let us know when the next crisis will take place. That'd be very useful. But if you're on the banking side, a lot of the banks and the lobbyists and the people on the other side of the aisle, so to speak, have been arguing, obviously, for less regulation. Is that the right path?
No, I mean, that's the path that we've gone down that has led to these recurrent intensifying financial crises. So the dynamic that is most destructive, and again, has not been fixed anywhere in the world, is the race to the bottom, also called the competition and regulatory laxity.
There's been a lot of proposals out there to regulate the financial sector, Dodd-Frank, just to name a few. Are you frustrated that perhaps more progress has not been made?
Well, virtually no progress has been made, and in many parts of the world, it's actually gotten substantially worse. Europe is actually considerably worse than the United States in terms of the banking system, which is one of the reasons why, even though many of the losses occurred in America, you can see that the resultant crisis was much more severe in Europe. And in large part, it comes to exactly the discussion that you played in the setup to this piece, and that is, what will the leverage ratio be? What will the capital requirement be? Europe had roughly twice as much leverage as the United States, and it caused calamitous problems. Indeed, it, of course, continues to do so.
I'm going to throw out a question to you. I want to get your opinion on it, because if we crack down on the banks and say you can't loan out so much money, you got to be more careful, the banks will then go to the customers and crack down on the customers and say, hey, we're not going to loan out all this money. We're going to be careful loaning out to you. Do individual customers ultimately pay for these new regulations? Are they the ones that could get hurt?
No, they'll be the big beneficiaries. The last crisis in the United States caused roughly $10 trillion in loss of wealth. A trillion is 1,000 billion. It caused roughly those losses in Europe as well. It cost 10 million jobs in the United States, well over 10 million jobs in Europe. So the little people are the victims of these things, and banks are not made better off. The things that caused the failure of Lehman Brothers and Bear Stearns was they had extraordinary leverage. They had essentially 2% capital. Of course, that was claim capital. They were actually deeply insolvent. And that's the thing that people have to keep in mind. Capital isn't some physical substance that's in a vault. It's simply an accounting residual. You take your asset values and you subtract your liabilities, and that supposedly tells you what your capital is. But it's easy to inflate your asset values, and it's easy to hide liabilities, and that means the capital is frequently fictional.
William Black, former regulator and professor at the University of Missouri, thank you very much for your time. Certainly a very complex situation. It seems like just yesterday we were watching Bear Stearns and Lehman.